Everyone assumes the biggest AI companies on Earth must be swimming in profit. Look at the valuations. Some of them are worth more than entire national economies, backed by the richest corporations in the world, running products hundreds of millions of people use every single day. Surely a business that size is printing money. Except it isn't. Several of the most famous AI companies on the planet are losing billions of dollars a year, on purpose, and they plan to keep doing it for years to come. So what exactly are investors buying, if not profit? Here's the idea that explains everything else in this documentary. An AI company doesn't really sell intelligence. It sells a bet, placed against the calendar itself, that computing power will get cheaper faster than the company burns through cash trying to stay ahead of everyone else. And here's the part that sounds backwards until it clicks. In most industries, growth is the reward. In this one, growth can be the punishment. The more users a popular AI product attracts, the more computing power it burns answering them. And if that product is priced below what it costs to run, success itself becomes the thing draining the company's cash. The more successful an AI company becomes, the more money it can lose. Read that twice. So how does a business built on that trap make money at all? Some of it comes from consumer subscriptions, a flat monthly fee for a chatbot or assistant. Some comes from enterprise contracts, where large companies pay far more for guaranteed capacity and uptime. A growing share comes from API access, where other businesses plug directly into the model and pay per use. A little comes from licensing. Almost none, so far, comes from advertising. And here's what surprises most people. Consumer subscriptions get all the media attention, but enterprise contracts and API usage are increasingly where this industry's most reliable money actually comes from. Now think about what it takes to reach the starting line. Before a single customer ever types a prompt, a company has already spent years and often billions of dollars paying researchers salaries most industries can't imagine, paying lawyers to fight lawsuits over training data, and paying chip suppliers for hardware running tens of thousands of dollars per unit. Training one top-tier model can require tens of thousands of specialized chips, pushing a serious frontier attempt into the billions before revenue exists at all. Elite researchers alone command compensation packages worth 8 or 9 figures, just to keep them from walking to a competitor down the street. Here's where the numbers start to feel almost fictional. One major AI lab has projected compute spending reaching roughly $50 billion in a single year, against revenue that, even optimistically, comes in near half of that. That's a company planning to lose tens of billions annually, with its own leadership acknowledging it under oath in a courtroom. Most people assume the expensive part is training a model, the one-time process of teaching it everything it knows. That's genuinely costly, but the ongoing cost of running that model for millions of daily users, called inference, eventually dwarfs the training bill entirely, because every question costs a sliver of real money to answer, multiplied across billions of questions a month. One case makes this painfully clear. In early 2026, OpenAI shut down its video tool, Sora, after it was reportedly burning roughly $15 million a day in computing costs, against about $2 million in revenue across its entire lifetime. The tool wasn't unpopular. That was the problem. Every additional user made the losses worse, because each video cost more to generate than it charged. The lesson isn't about one product. It's that popularity, in this industry, isn't automatically a viable business. That pricing wasn't an accident. Companies often price below cost on purpose, especially early on, because a cheap tier builds habits and market share before competitors can react, betting that prices can rise later, once switching away has become expensive. Cheap today is often the down payment on expensive tomorrow. Meanwhile, enterprise customers pay rates much closer to the real cost, sometimes above it, quietly subsidizing everyone else's cheap habits. Running the business day to day adds a long list of quiet expenses. Cloud hosting fees, cybersecurity, legal settlements over training data, insurance against catastrophic failure, an entire discipline called red teaming, where staff try to break the model before the public can, compliance costs, chip depreciation, and constant retraining to avoid falling behind. Growth alone starts to look like a fragile foundation for survival. But that's only part of the story, because there's a detail buried in these companies' finances that surprises almost everyone. Some of the biggest labs are financed in a loop that sounds circular because it is. A chip manufacturer invests billions into an AI company, which turns around and spends much of that money buying chips from the same manufacturer. A cloud provider extends enormous credit, and the AI company commits a huge share of revenue back to that same provider's servers. Money moves in a circle between a handful of companies, each propping up the other's numbers. There's another force at work, the same one that decides who wins in almost every subscription business. Customer lifetime value against acquisition cost. Winning an enterprise client can cost a fortune up front, but if that client stays for years and expands usage, lifetime value can dwarf that cost many times over, which is exactly why these companies tolerate such enormous short-term losses. Scale matters too. The largest players negotiate cheaper electricity, chips, and financing than any smaller rival could touch, and that gap widens over time. Combine that with operating leverage, where each new customer costs little to serve once the infrastructure already exists, and a business that looked catastrophic on paper can turn dramatically profitable once usage crosses a certain threshold. Now here's the psychology keeping this machine running. Investors aren't calculating discounted cash flow the way they would for a normal business. They're driven by optimism bias, treating today's losses as the price of owning tomorrow's most valuable technology, reinforced by commitment bias, because walking away after tens of billions feels unthinkable. Customers behave differently, but just as predictably. Habit formation means once someone builds a daily routine around one assistant, switching feels like relearning a skill. Social proof pushes whole industries to adopt the same tool just to keep up. And businesses keep paying premium prices because reliability has real value. Because switching means retraining staff and rebuilding trust with a new vendor, a cost that often outweighs whatever a cheaper rival might save them. There's another layer worth sitting with. Competition here isn't just about who builds the smartest model. It's about who survives the losses long enough for costs to fall. In early 2026, the Chinese lab DeepSeek released a model performing close to the leading American systems at a fraction of the training cost, and one chip manufacturer's stock lost close to $600 billion in a single trading session, the largest one-day loss in American stock market history. The lesson wasn't that a cheaper model appeared. It was that a technological lead can vanish in a weekend, while the financial obligations built on top of it, the debt, the data centers, the multi-year contracts, take years to unwind. Regulation adds more uncertainty, since a single new law on data or safety testing could force a costly retrain, or force a company out of a market entirely. Add funding rounds falling through, rising interest rates on enormous debt loads, and the constant threat of a cheaper rival undercutting you first. And even the most celebrated names in this industry call their own position fragile. So walk through the real financial journey. Initial investment can reach tens of billions once chips, talent, and data are counted. A leading company might earn 10 to 20 billion a year in revenue. From there, roughly $30 to $40 out of every 100 disappears into inference alone, with more consumed by training, salaries, and infrastructure. What's left is a gross margin often sitting in the 30s or 40% before overhead. Once legal costs, compliance, and debt servicing are subtracted, net margin often turns negative entirely. That's the trap. A company can earn double-digit billions and still lose a similar amount in the same year. Break-even, if it comes, isn't measured in months but years, contingent on revenue tripling and compute costs falling substantially. Owner income barely exists yet. What exists instead is equity value, the bet that being first and biggest when the curve finally bends will be worth more than any dividend along the way. Investors tolerate the losses because the return they're underwriting isn't annual profit. It's a shot at owning a decisive share of a trillion-dollar industry, if the company is still standing when that day arrives. So who succeeds, and who fails? The winners keep raising money at a scale most industries never touch, while cutting costs fast enough to catch their own spending, and building enough loyalty that leaving becomes genuinely painful for their biggest customers. The companies that fail rarely fail because the technology was bad. They fail because they ran out of runway one funding round too early, or because they built something so aggressively subsidized that its own popularity bankrupted it. Nobody expects that, but it keeps happening. So the next time you see a jaw-dropping valuation attached to an AI company, don't picture a business quietly printing money. Picture a company sprinting on a treadmill that keeps speeding up, spending fortunes just to stay in place, betting the finish line arrives before its legs give out. Everyone assumed these companies were selling intelligence. In reality, they were buying time, hoping they could afford enough of it before someone else caught up.